Alright, hello everyone, this is Nick Lump. This video is being recorded on Saturday morning, February 15th. The missus is a CPA and it's tax season, so she's at work today. And I just watched an incredible hockey game between USA and Russia. Went like 8 shooters deep in the shootout and USA won. So I wanted to record this video, do a little recap on what's going on in the markets here. I wanted to get this out yesterday, but it was Valentine's Day, so figured I'd record it this morning. So what we're going to look at here, this is the S&P 500, and we had a rough 2 weeks, but since have recovered pretty nicely over the past two. And so let's take a look at a few lines here. I was targeting initially 1730, this red line that I thought we'd take a dip to. We didn't quite get there, but reversed pretty quickly, and we've been on the climb. Now, a really nice sign what happened was last Friday, we closed over this line here, and what happened as we were falling, we traded back and forth right here in this zone, the 1775 to 1795. And what was happening, this is called kind of building value, as the market there's a balance between buyers and sellers, and we just chop back and forth. Now as we fall out of here, and then we reversed and came back in, it's a really good sign that it cleared straight through the zone and closed above it. This is something that's called market profile theory. It talks about how the market will always search for value. And so, if it moves higher and there are, let's say, a lack of sellers, then the market needs to continue climbing higher to a point where people say, you know what, I'm willing to sell up here. Or, the opposite, if there are, let's say, a lack of buyers, market needs to continue to fall until it gets low enough that people step in and say, I'm willing to buy down here. So it's always moving back and forth, looking for that balance between buyers and sellers. And what happens though is as a market moves one way, so for example, we were trading here, we fell out of this. When it comes back in, if it can clear through that range, it's a sign that it should push higher and now search for value at higher prices. So the key this week coming up is going to be whether we can clear this line up here around 1840 and start to find value and trade up above here, above 1850, or if we're going to start to retrace. We'll need to find support around this oval right here, because if we break through this at 1795 and we close down in this range again, that will be a sign that there's a lack of support, a lack of buying up here, and that will be a bad sign that the market could take a dip and probably would make new lows at that point down here. And if it does, I'd say it'd probably move to this 1680, 1700 range. So this will be a kind of a key area of support in the upcoming week, the 1795 to 1800 range. And it was a really odd week this past week. As you can see, we've just been climbing straight up in a straight line. This is what you see when you have a lot of short covering, which is when people will sell stock short, hoping that they move lower to profit. And when it climbs, they get forced to buy to cover their positions, and that buying just drives it straight up. So we've had just multiple days in a row of just a very smooth, low volume, straight line higher, and closing near the highs of the day. So it's odd in two ways. One is because really on Thursday and Friday there was a lot of distribution, a lot of selling toward the end of the day. So that could be a sign of a lot of profit taking up here toward the highs, which means that there's a good chance we retrace to this level. The other one, if we look at some of the other markets, look at the yen, bonds, and gold as we did toward the beginning of the year. So let's look at these four now. Up here in the top right is the Japanese yen. The bottom left are the US 30-year Treasury bonds, and the bottom right down here is gold. We looked at these at the beginning of the year after the first week or so, and they gave us an indication that the stocks were about to take a dip. Now, what can happen a lot of times, and especially after the change of a year, for example, I've said before that the market can kind of change its attitude, and I think we may start to be seeing that. So let's kind of take a look at these real quick. Usually, or what happened in all of 2013, is these markets were moving in the opposite direction of the stock market. And you can see that after the stock market right here bottomed and started moving higher, these started to kind of take a dip. The yen started to fall, bonds started to fall a little bit, gold took a little dip, but they've all since kind of reversed. And on Wednesday, Thursday, Friday, found a little bit of support here. The yen was moving higher, bonds moving higher, and gold really took off. I'm looking at the yen and bonds the most as an indication. If they can tip over and start falling again, that will be confirmation that the stock market should continue climbing. If they don't and they hold and they even move higher, that will make me a little nervous, and then I'll think that we might take this a little pullback here, and we'll have to see if we can hold this level or not. Gold, I think, is again changing kind of the attitude, and I think you're seeing gold start to run away. This is also looks like short covering to me too. Gold had a absolutely terrible 2013. A lot of people were short, and you'll get these pretty sharp retracements where they're forced to cover. I'm not sure if gold has put in the low yet or not. I actually still think there's a good chance it finds a new low down here, down 1150 or lower. But I think what's going on right now is there's a lot of civil unrest and rioting going on in a lot of emerging countries like Ukraine, Turkey, Thailand, Argentina, and you're seeing really vast moves out of their currencies. They're falling pretty dramatically. It's going into the U.S. dollar and it's going into gold as this safe haven against these. Basically, people don't trust their governments because they're corrupt, and their currencies are taking a hit because of that as well. So you're seeing this kind of flight to quality into gold. I think that's the disconnect we're seeing is because of that. So again, I'm looking at the yen and bonds as a better indication, and I'd like to see them both tip over as a confirmation that this market will hold up here and press higher. The other thing that I wanted to talk about real quick was kind of looking at 2014. I do still have a pretty positive view for U.S. stocks especially, but looking at, I think an important thing to watch this year is going to be interest rates and the yield curve. And if the cyclical forces within the global economy can start to pick up and really, pick up growth, you'll see interest rates creeping higher, or at least you should. The really interesting thing, now that we've had a change in the Federal Reserve, and the new chairman is, chairwoman is Janet Yellen. I guess we'll say chairperson. It'll be interesting to see if their policy changes and how that might change, because the Fed is standing pat that they don't want to raise short-term rates until they're saying at least 2016. They're saying this because they don't want interest rates at the longer end of the curve, at 10-year rates and 30-year rates, to move higher. Now, the thing is that they really can't control the longer end of the curve. They try to influence it, and they try, to buy bonds and support it. But if the market starts to move it, the Fed can't stop it. And what can happen if the yield curve steepens, which means long-term rates, at the long end of the curve rise, meaning 10-year and 30-year rates start to rise, while the Fed is holding short-term rates near zero, that creates a very steep curve from 0% up to what could be 4 or 5%. That's historically a very, very steep curve. And what can happen is that can really push the Fed's hand in forcing them to raise rates earlier than they want to. Basically, the market is telling the Fed that they're wrong and you need to raise rates and make them higher. I'm looking at Great Britain right now because in a similar event, you're seeing Great Britain's economy pick up quite a bit over the past 6 months. The British pound has rallied quite a bit, and their central bank is basically, they're doing the same thing at looking at trying to use forward guidance to say when we're going to raise rates, and their market is starting to basically, it's pointing that they're going to raise rates before the U.S., possibly a year or so before. So I'm watching to see how Great Britain is handling this and how their bond market is reacting. That could give an indication of the U.S. as well. And I think what we could see this year is a slight pickup in inflation. And if that happens, you will see interest rates move higher and bonds sell off again. That, longer term, there's been this really big battle between inflation and deflation, and that's why we've really central banks from Switzerland, European Central Bank, Britain, United States, and Japan have printed trillions of dollars because they're trying to stave off deflation. But if inflation actually kicks in a little bit, we'll see what happens with rates, and if then central banks start to kind of pull back on the stimulus and the quantitative easing, and where that takes things long term. So a bit of a longer video. Sorry if I sounded like I was rambling there, but these are the things I'm watching this week, and we'll see if stocks pull back. This is the level I'm targeting that needs to hold, and if it does, we'll likely see higher prices through the spring.